And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. I'm your host, Lance Roberts. This is, of course, the pre-Friday Eve edition of the Real Investment Show here on the at realinvestmentadvice.com. It never amazes me the amount of gullibility that people have, right? I mean, did you really think if you got a tweet from Joe Biden or Barack Obama that says, if you give me $1,000 of Bitcoin, I'll give you $2,000 back? Did you really think that was a real tweet? But importantly, I mean, there was a lot of people that sent Bitcoin. Mm-hmm. By the way, you really think Joe Biden, who is like 900 years old, uses Bitcoin? I mean, that's...
Does he even know what it is?
And more importantly, does he even remember what his passcode is? That would be the real question. He may say he'll give you 2,000 Bitcoin back if he can remember how to get into his wallet. That's going to be the real question. Anyway, but yeah, I mean, I just thought that was interesting. Of course, it turned out to be a hack. Somebody got into the user management panel at Twitter. Twitter this morning is going to be down about 5% on that news. People are not real keen on getting hacked, but yeah, a lot of people are going, could you please send my money back? No, you're not getting it. You're not getting it back. I feel sorry for these people. Like this one person tweeted out, maybe she was, not telling exactly all the truth, but she's like, this is my life savings I sent to you. But there's a point about this, right? So what we've done with the markets as of late is we've taught people to gamble, right? To speculate. And so here was a too good to be true offer, right? Barack Obama, Joe Biden telling you that, hey, if you'll send me $1,000 in Bitcoin, I'll send you $2,000 back. Easy money, right? So here's this one person, whether she's telling the truth or not, I don't know. She says she sent her whole life savings. Would you please send it back to me? No, you're not getting it. And this is going to be a hard lesson for a lot of people to learn. But, when things are too good to be true, they usually are. And when you treat investing like speculation, you're eventually going to lose. There's an old saying that applies to Las Vegas as well as it does to the financial markets. Eventually, the house always wins. And, that's the important part about learning lessons about investing. Yes, this time always seems to be different throughout history. And they never are. And whether we go back to 1999 or whether it's 2007 or 2020, the lessons that are eventually taught by investors chasing speculation, being overly aggressive, always tend to turn out poorly, and it impacts their financial situation. So just, pay attention to kind of what's going on in the world around us. We've got a lot of crazy stuff going on. Speaking of crazy stuff, you're familiar with who the artist Banksy is, right, Brent?
Banksy,
yes. He's the famous graffiti artist.
Okay.
You're familiar?
No.
Okay, so Banksy is this graffiti artist. I can't believe you don't know who Banksy is. You're well-rounded.
Well, not that well-rounded.
No, there you go. Well, Banksy is this graffiti artist, and he's world-renowned. He's this kind of this mystique character. Nobody's really sure who Banksy is.
Is this the guy that does all the railroad cars?
Yeah, he does. No, not the same. That's not the same Banksy. Banksy, though, is famous for doing a piece of art that got sent to Sotheby's.
Really?
For auction. And in the middle of the auction, it shredded itself.
I saw
in the
that
middle
story.
Okay, there you know. Okay, that's Banksy, right?
Yeah.
So Banksy is this mysterious graffiti artist. He shows up and does these works of art. And again, if you go online and look up Banksy art, I mean, there's reprints of his art that you can buy. My wife's a huge fan of Banksy, right? So anyway, just interestingly enough, he snuck onto a London subway, the tube, mind you, where it says "Mind the Gap" when you walk out of the tube, if you've ever been to a London subway. And he did a piece of graffiti art to tell people to basically wear masks. And it's he painted rats, inside the London tube, sneezing like on the windows and everything else. So just trying to encourage people to wear masks. Well, the workers erased it. So, they came in, they scrubbed it down, and they erased it, and people were upset. It's like, that's That's a Banksy. You're destroying a Banksy. People are very upset. Probably Banksy knew that this was going to happen. It violates the London subway rules that, they can't have, the graffiti violates their rules. The London subway did offer Banksy an opportunity to come do another piece of it somewhere else that's more acceptable so that their riders can enjoy the art.
Yeah,
but,
we've got a railroad trestle he could hit there on I-45
I'm sure
north
he
of
does.
downtown.
But anyway, I thought it was very interesting. Everybody was very upset that they erased a piece of Banksy artwork.
Wow.
But there you go. But hey, he was trying to get the message out.
Sure.
Wear your freaking mask if you're out in public. So, speaking of that, we're right in the middle of this whole. This kind of reversal of this reopening process in the economy. So we were having this reopening process coming from an actual shutdown, right, to reopening. And now there is a rising trend about either pausing or reversing some of the reopening. And we talked about California yesterday. There's starting to be more concern now with more and more rising cases in Florida and Houston and other parts of the country that, we may have to either slow down or stop or potentially reverse some of the reopening process to try to contain the virus. I mean, we're getting new record cases every day. ICUs are filling up once again. So that's one of the kind of the near-term concerns. And it's important to pay attention to this because from a market perspective, the market has been unable to get above its June highs. And we've now been rejected twice over the course of the last couple of days. In particular, we've had 3 attempts now to get above that June high, have been unable to do it. The markets are going to be lower today. And, this is this kind of consolidation process that we've been in continues at this point. Now again, this isn't, a panic run out and sell everything because, again, we do have a lot of support sitting here where the 50 and the 200-day moving average have crossed. But as I wrote about in Tuesday's article on the website, there is a lot of support here. This golden cross, as it's called, is typically bullish for stocks, but not always in the short term, because by the time this happens, markets are very overbought, they're extended typically, and so you get some type of correction. So there is potential here. Over the next month or so, we could have a bit of a correction in the markets. If we do violate these 2 moving averages, now it's going to be a different conversation we're going to have at that point. But right now, we're still fairly confined here in a very tight market range. So be a little bit cautious here. Take a little bit of risk off the table. last week we talked about taking profits in Microsoft and in Netflix as well as Apple. All these stocks have peaked recently, and these have been the big drivers of the markets. And this process here, Apple, Netflix, Microsoft, these have all triggered money flow sell signals currently, suggest that we're in the process of at least a consolidation here at these higher levels, if not a bigger correction. And again, we're about to move into earnings for a lot of these companies, so there's risk of disappointment on the earnings front as well, particularly with Apple. I think there's a lot of risk there. But anyway, this is why we took profits here. We didn't sell the whole position, so don't think we were just completely out of these positions, but we did take profits here just to reduce our risk. Again, just as we move out of July, and we're going to talk some more about this with Michael Lebowitz here in the next segment, as we move out of July into August and September, as we move up into the pre-election run, there is risk of a market correction. So again, we'll talk about this when we come back from the break. Be sure to get by the website. We've got new articles posted out this morning. And of course, as always, answering your questions and comments. So feel free to send those to us. Answer those every single day. RealInvestmentAdvice.com. We'll be right back.
You might as well face it, you're addicted to love. You might as well face it, you're addicted to love. Might as well face it, you're addicted to love. You might as well face it, you're addicted to love.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Baby shark, baby shark, baby shark, baby shark, mommy shark, mommy shark.
And welcome back to the show this morning at 6:18. Michael Lebowitz, CFA, joining us this morning live from his bunker up in the D.C. area. And the reason that is you got a lot of stuff going on up there where you live. You got the Redskins changing their name now. Right. That's going to be, I guess they're having some trademark issues, I guess, on whatever new name that they've got. So they haven't announced that yet. But then, we've also got this, what?
There's a trademark on snowflakes?
I'm not sure, but apparently Frosted Flakes probably threw a fit over that.
Yeah.
So they're afraid that they're going to use Tony the Tiger as the logo. So
Somebody would figure out a way to be offended by that too.
I am sure. Anyway, but but also we've got this whole issue now of the election coming up, and as we move into August and September, I mean, we're about to get really into the whole the whole crux of the pre-election. We're going to have the debates coming up and a lot of this. So, there's always some potential risk to the financial markets in the short term, particularly when markets are uncertain about what policy will be under a potentially new president. I mean, the markets are kind of, they kind of know what they're going to get with Trump, but you're not really quite sure what you're going to get with Biden. Is he going to go to start raising taxes on the wealthy? Is it going to be, a green energy policy? And he's been talking a lot of this, teaming up with Bernie Sanders and Cortez trying to implement this whole kind of MMT green energy policy. We're going to convert the entire economy. That may not be favorable for markets in the short term.
You know what? That's what they said about Trump 4 years ago. And the market has pretty much had one bad day since then. The first day he was elected, the market, S&P was down, 10% that night?
Yeah.
And it's done nothing but rally ever since, give or take a few hiccups along the way. So I think it's hard to know what a Biden presidency would mean for the markets. I'm sure it'll be spun to be a good thing. Sure. Right? We'll have more clarity. We'll have more consistency, no volatility, no tweeting. And it'll all be, the narrative will change. The narrative will change that all of a sudden Biden is good for the market and Trump wasn't good for the market. The market narrative.
But really not
shifts.
so much after. But not so much after the election. I guess it's more concerning about going up to the election.
I agree.
Yeah.
Right. And that to me is the biggest concern. Normally, the election is a big deal, right? You got potentially a new president, new policies. This time, we're in the midst of a pandemic, a recession/depression, where the only thing that's keeping the economic data looking awful instead of really, really awful is massive stimulus like we've never seen before.
Right.
I mean, we're not even just talking about 2008 stimulus. We're talking about much more than that and directly to the people, which we did not see in 2008 as well. Mm-hmm. So a lot of this stimulus, right, on July 31st, the unemployment claims the additional $600 per paycheck goes away. The benefit of that $1,200 check from a couple months ago is pretty much gone. So a lot of that stimulus is gone, right, or going away. So the question is, will it be extended? Will there be new stimulus? And then it becomes very political. How much does Nancy Pelosi want to help the president? How much do Senate Republicans want to show that they're willing to be not fiscally conservative? There's a lot of political issues on both sides of the fence on how they want to posture for November. And that will create a lot of volatility over the next few months.
Yeah, and I think this will be really kind of an interesting point too, because Congress is in recess until July the 20th. When they come back, we talked about this earlier this week. They've only got basically 10 days to do something with those increased unemployment benefits, because that extra $600 a week expires at the end of the month, and then everybody just falls back to the regular UI benefits, which that's going to substantially decrease the personal income run that's been helping support consumption here as of late, and giving businesses some optimism that there's going to be an economic recovery. They're seeing some extra spending, these type of things, but that's due to this artificial boost from the government that is going to go away at some point. Even if they extend it now, it'll go away at some point down the road. But this is going to be a potential drag immediately if they don't get that extended. And to your point, it's, when you're looking at a $3 trillion deficit, the debt ceiling's coming up. We're going to have to pass another continuing resolution here. So the fiscal year for Congress ends on September the 30th. So they're going to be dealing with having to pass a continuing resolution, which is also going to incorporate all the negotiations that go on. And at some point, you've got to imagine that
if Republicans want to maintain their majority in the House, they're going to have to start talking about reducing the debt, reducing the deficit, and starting to at least talk. Now,
Right.
whether or not they actually do anything, they've got to at least talk the talk that they're going to, be a little bit more fiscally conservative.
In the Senate, their majority in the Senate, but that's that's a really good point, Lance. If Biden has a big lead, and we're talking September, October, and it appears imminent that he's going to win, which it appeared imminent Hillary was going to win. So,
Right.
so let's be careful with that word. But let's say Biden has a 15-point lead, and he's winning Florida, he's winning the Midwestern states. All right, he's winning all the states that'll get him. I bet the Senate Republicans take a very different tack towards Trump and try to separate from him.
Right.
They're going to do whatever they can do to keep their majority, to keep their seats,
Right.
and at the end of the day, keep their majority. So, predicting the outcome of the election and because of that, predicting how senators and representatives are going to work together or what they will support and what they won't support is very difficult. And now more than ever, that's the most important thing an investor can understand is how will stimulus continue into the future.
Right, because unfortunately, that's now what we're totally hooked on in terms of support for the economy, support for the markets. It's all about stimulus, and you and I have both written articles about modern monetary theory and this idea that we can just print deficits and print debt with no consequence, and just to fund anything that we want to fund is all fine and dandy in theory, but we're already even abusing the theory. The theory is that you use debts and deficits for productive investments that create long-term benefits for the economy, but yet now we're just printing debts and deficits to fuel short-term spending, which has a negative long-term impact to the economy.
Right. And everything I've seen, and maybe I missed something, not one piece of debt that the Treasury has issued over the last few months in COVID has been productive.
Right.
Right. It's gone to pay some immediate bill or pay someone to pay some immediate bill or for immediate consumption. None of it. There's no Hoover dams in any of these things. There's no infrastructure. There's nothing that at least will pay some sort of dividend in the future and help you repay that debt.
Right.
In other words, this money's being spent. There's debt accumulating. The money's spent. The economic stimulus is gone. Right. It lasts and then it's gone. But the debt's there.
Right.
And that's why economic growth will be less in the future than it was before COVID.
Well, that's really kind of the point that we're getting to here is that, we're, over the next couple of months. So we've had this nice reflexive recovery in the financial markets. It's expectations of a V-shaped recovery in the economy, which is why stocks have been doing so well. But now, we're seeing surging cases in the virus in Florida and Texas, California, others, and New York has done a good job at this point of getting their cases redone. Now they're reopening, but they run the risk as they reopen of those cases starting to surge because of the population in New York and up in the Northwest. Y'all are much more tightly compacted. In Texas, there's 20 miles between us and our next door neighbor. But we were built for social distance in Texas. But I mean, there's a risk of resurgence in New York.
But here in D.C., so in at least Maryland and Virginia, we were kind of on New York's trajectory to some degree, a week or two behind them, but it was under control. And now the last few days, it's picking back up again.
Right. And that's the real risk. I mean, there was an interesting chart I tweeted out this morning. It says there's the bull market in closures because we're seeing a lot of states now beginning to talk about reversing the reopening process or at least pausing it. Implementing mandatory stay-at-home orders is now being kind of talked about in more and more states, and that will certainly impact the reopening and recovery of the economy. Certainly slow it down to a large degree. And that certainly puts risk in the markets currently.
I mean, look, here's the bottom line. Here in Maryland, we're in what's called phase 2, I believe, which basically means restaurants could be half full, takeout orders, stores have a maximum capacity. Things are kind of running normal, although at half capacity, so to speak, right? No stadium events, no big indoor events, right? Mm-hmm. I don't see how we get to the next phase.
Yeah, I agree.
I just don't see that coming anytime soon.
Well, that has ramifications, that's for sure. All right, quick break. We're going to come back, pick up with Michael Lebowitz, talking a little bit about, so that we've had this crazy rally in the market, right? Stocks are going up. Seems that nothing cares about anything. But is this really just the fingerprints of passive investing? We'll talk about that when we come back with Michael Lebowitz right after the break. Don't go away.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Everybody get up!
And welcome back this morning. I'm your host, Lance Roberts. It's 6:33 on the Real Investment Show. Michael Lebowitz, CFA, joining me this morning. So we're just talking a little bit about this idea that because of the debts, because of the deficits, because of this abuse, really, of economic theory. And again, we're talking about modern monetary theory here, but look, we've abused Keynesian economic theory for the last 40 years. And that's why we are in the hole that we're in now, because we didn't really work the theory the way it was supposed to work. We just latched onto the one part that says, if you have trouble, spend more money on debt and then everything will be fine. It's never really worked out that way. Slower economic growth, weaker wage growth, widening wealth gap, economic prosperity has been weak for 80% of Americans. But you just wrote a very interesting article about, which is on the website right now, about this idea about the fingerprints that are on the markets and really, in a lot of ways, on the economy as well. This idea of slower growth and then what we're paying for things. Particularly in the markets. And Apple is a good example of that. And we talked about Apple this morning on the show a little bit. We were talking about selling and taking profits out of our tech stocks last week. That's been a good trade so far. A lot of those have started to correct here a bit. But there's a real hurdle here. People are paying a tremendous amount of money in terms of every dollar of revenue these companies generate, on the expectation that this is going to continue into the future, but that may not be the case.
No, and I think Apple and Microsoft are good examples, right? Companies like Netflix or Tesla or Amazon, you can make a story that they're going to grow significantly in the future. Whether we believe the story or not is irrelevant, but Tesla can grow in the future. Mm-hmm. Amazon can grow significantly in the future. Apple and Microsoft are much more utilities, and their revenues have really flattened out over the last 5 years. So you're buying great companies. Don't get me wrong; they are great companies with great products, but their revenues have been relatively flat, sort of like utilities. They grow at basically the economic rate. So if we just look at Apple stock is up about 20% from where it was before COVID started. Let's say late January, early February. So you have to pay a 20% premium in price to what you had to pay in late January. Now, at the same time, we are in a recession, a bad recession, and we will be in a recession for a while, and economic growth is not going to the rate of economic activity will not get back to where it was for, at a minimum, 3, 4, 5 years, right? Meaning that Apple sales will not get back to where they were, barring any new models, everything being equal, and that's an assumption here, everything being equal, their sales are going to follow the economy to a large degree. They're very well correlated. So then it's how we ended the last segment, right? Well, because of all this debt, economic growth will necessarily be lower than it would have been had we not had this recession.
Right.
So we have this trough in the economy, right? And we have a slower growth rate coming out as we recover than we would have. So there's going to be less economic growth for not just until we recover, but for the foreseeable future. So now you look back at Apple, right? You're paying 20% more and you will be getting less in revenue, less in earnings. So why? And let's, to be fair, Apple was expensive before COVID. Right? You were paying a lot for what's basically a steady earning utility stock. Again, a great company, but you're paying a lot for it. Now you're paying 20% more, paying more for less.
This is an important point because we're seeing this in a lot of stocks. We wrote an article recently talking about the number of companies that are trading at 10 times price to sales.
Right.
And that requires a tremendous growth rate. But there's stocks that we have currently trading at 20 and 35 times sales, which is an astronomical, it's an infinite growth rate for these companies that they will never be able to achieve, just even in the best of circumstances. They'll never achieve that growth rate. But yet, investors are paying this and then trying to rationalize overpaying for things now, saying, oh, well, yeah, but in 2 years, the earnings will be better, so I'm going to pay for it today. But that's like buying a $500,000 house in a $250,000 neighborhood that'll be worth $500,000 2 years from now. You don't make any money that way, and that's really the key point here.
No, the key point is, look, you can buy that $500,000 house if you think you can sell it for $550,000 to someone else in the next week or two, but know that it's worth $250,000. And look, we own Apple. We've been taking some profits. We know what we're getting into. We're by definition value investors, right? But this market is forcing us into some of these high growth stocks. And we know that these are trading positions, not necessarily long-term positions, because we're paying an awful lot for them. So why are we doing this, and why are so many investors doing it? Because passive investing, the passive strategies are the new thing, right? So there's passive and active. Active means that you go comb through financial statements and you find companies that are really cheap, that have that you're paying a very low premium for revenues, for earnings. They have the potential for good growth, and you're just getting, you're buying that $100,000 house on the $250,000 block. And then there's passive investing, which says, I don't care. I just want to buy the block. I'm going to buy the whole block. I don't care what any house is worth. I just want to own the block. Right. And in that block, there's the $100,000 house and the $500,000 house and everything in between. The problem is the way these indexes are constructed is they're market weight, they're size weighted. So in other words, when you buy, and we wrote about this in the article, when you buy the S&P 500, if you're buying $100 worth, you're buying about $6+ worth of Microsoft and about a penny worth of Xerox. So you go to market and you buy, your $6 worth of Microsoft. That has a bigger effect on price than your penny of Xerox. So what happens? The Microsoft's price goes up a little bit. Xerox goes nowhere. Now Microsoft has even a bigger market cap. It's even bigger. Market cap is just the price of the company times the number of shares. So now the next guy, so Lance comes in after me, and he has to buy 6.1 of Microsoft for every penny of Xerox. And this becomes very circular. Right. Now you may ask, okay, well, at some point, doesn't Microsoft become, right, if you take it to its natural end, which could never happen, but if you do, Microsoft is worth 98 cents on the dollar, and everything else is worth 2 cents on the dollar. Right. The problem is it works in reverse just as easily. If I have to sell my position because I need cash, because I'm scared of the market, because the market falls, because of any number of reasons, I have to sell my $6 of Microsoft, but I only have to sell one share of Xerox, one penny worth of Xerox. Right.
And that's kind of what we saw back in March during the decline. One of the reasons that the sell-off in March was so dramatic, and you had a 35% decline over the course of a couple of weeks, was a lot of this, because when we saw when that started happening, people were dumping ETFs, they were dumping stocks, and we had warned about this over the last couple of years. We'd written articles saying, hey, when somebody yells fire in the theater, it's going to be very, very fast on the exit, because as people sell the ETFs, that also forces the sell of the individual stocks, and if people are selling the individual stocks as well, that's also dragging down the price of the ETFs, which is now forcing more people to sell the ETFs. And we saw that just, markets were down, on the Dow, 1,000, 1,500, 2,000 points in a day, just phenomenal daily moves in the market as people were literally just liquidating everything they had. But that's part, as you said, the passive indexing thing boosts markets on the way up, but it also evaporates markets on the way down.
Right. And maybe we can talk a little bit about this, passive hedging, right? A lot of investors were spared some of the pain, definitely in 2008 and 2000, and even in March, because they own bonds. Right. And bonds did really well, so they were spared the pain. If that happens again, what we saw in March, they're not going to be spared any pain, because yields have very, very little to go lower. Right. And that's going to be, if the market's down 30% and you're down 15%, you say, okay, this isn't so bad. I can hang in there. Maybe I'll even buy here at the lows.
Right.
Right. But if the market's down 30% and you're down 30%, it's a different attitude you may have, and you may react by, and we see this frequently at market bottoms. Retail investors start selling when they should be buying because they're panicking.
Well, and it's interesting, one thing that we've done over the course of the last decade is that we've trained investors that whenever the Fed steps in to start providing liquidity, then everybody runs and starts buying stocks, because it's kind of like Pavlov's bell. The Fed rings the bell, investors buy stocks. And now it seems that the Fed is now trapped in every single situation to where if you have even a minor decline in the markets, they're going to try to come in with QE to help support asset prices. So, the problem on both the bond side of the portfolio as well as the equity side of the portfolio is that you have no price discovery. And it's at some point, the Fed's going to step in with liquidity, and it's not going to work. And then investors are going to really be toasted. So quick break. Quick break, though. We're going to come back. We'll finish up with that thought. Michael Lebowitz right here on The Real Investment Show. Don't go away.
Edge of the world and northwestern civilization. The sun may rise in east, at least it settles in a final location. It's understood that Hollywood sells Californication.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
I'm your host, Lance Roberts. We're in the middle of a conversation here, but I just got to segue real quick there's just a headline. CNBC just posts some of the most stupid things on their channel from time to time. A $10,000 investment in Amazon from the day they IPO'd was worth $20 million plus today. What they failed to tell you is that for about a decade, that $10,000 was worth about $10,000. And even less. And that's the problem with all this. It sounds like a great thing. Oh, Mo, if we could all invest in hindsight, right? And if I could go back to, World War II and invest in Coca-Cola, that sounds great, but that's just not the way investing really works. But what that does is it entices people. Well, if that occurred, maybe I better buy Amazon now because that's going to happen again in the future. And that's not the case. We were talking about Apple and Amazon becoming mature companies, becoming quote unquote utilities. Amazon's headed there too. Amazon's reaching the point to where there's only so much consumption that they can absorb. And if Amazon was the only store, there was no Walmart, Costco, any Target, any other type of retailer in the world. If they were the only retailer, there's a finite amount of revenue that they can generate. And that's going to be one of the issues. So to create the same type of returns, by advertising things like that on CNBC is really, really bad for investors. But this is where we see investors make bad decisions, over time. Anyway, sorry. No, but that's a great point. And if you really think about Amazon, they are so big that they just can't pick. Let's just say they decide they're going to go into sporting goods and they're going to be the whole sporting goods market. Mm-hmm. Even if they take that whole thing over, how much does it really help their revenue? It's really just a small part. That they're growing so big that all these pieces, which are monstrous on their own, do not do much to the bottom line, making growth harder and harder and harder in the future. Exactly. So let's go back to our conversation, that we're having. So it's an interesting dynamic where we are, and this is, what we work with in our portfolios as well. And we've talked about this recently, and we wrote about this last weekend's newsletter, which is on the website now, realinvestmentadvice.com. Just click on the newsletter link, talking about the fact, we were taking profits in some of our tech stocks last week. We've written that we have been, moderating our bond portfolio. We adjust duration and credit quality to provide hedges, against equity risk. So when you have a market decline, typically money flows out of risk on equities into risk off, which is bonds. The problem is that the benefit of owning bonds is providing less and less, and this is where we left off, providing less and less support against a declining market. Now, look, rates are there's a lot of talk about, rates are going to rise. The bond bull market is over. Jeremy Siegel said that recently, and rates are going to go to 4 or 5%. No, they're not. Two reasons are rates can't rise. There's too much debt in the economy. If rates go up, you completely kill the economy because of the cost of debt. The second thing is, more importantly, as soon as rates start to go up, which will have a hugely negative impact to the economy and the Fed's balance sheet, they're the world's largest hedge fund now, they'll insert what's called yield curve control. I just did a podcast yesterday with Dr. Don Rich talking about this. We'll be airing that next week for you. Really great interview about the impact of the economy and yield curve control in particular. But rates can't rise because the Fed won't let them rise now.
And by the way, if they do rise, say goodnight to stocks.
Yeah.
Because stocks, the only reason people own stocks is because you get nothing in yield in bonds, right? And then when you do the whole valuation and forward earnings and all that stuff, higher yields make stocks look worse.
Right.
Right. It's just a huge problem, and I agree with you. Yields may rise, but it's economically a massive problem for a debt. For the economy, which has so much debt in it right now.
Yeah.
But I think the most, I'm going to harp on this week in and week out, Lance, because I think this is the most overlooked story, both by retail investors all the way up the professional chain to investment managers. Many people, individuals, institutions, pension funds, endowment funds, own some sort of balanced portfolio, some combination of stocks and bonds. And in the past, when the market has drawn down 40, 50%, those bonds have paid well, right? They had a nice price return and offset the losses. So again, I believe I said this earlier, when the market was down 30, 40, 50%, you may have been down 15, 20, 25%, making the losses more palatable. And then, when you think the market's towards the bottom, look, I lost 15%, but I made 7, 10, 12% the last 5 years. That's fine. Price for admission, right?
Right.
Well, and even in March, there was benefit to owning 5-year bonds, 2-year bonds. I mean, we had some 2-year bonds that did well, right? 10-year bonds, 30-year bonds, treasury bonds, corporate bonds. But those yields have come, the 10-year yield's about 0.60 now, right? So how much lower can it go? And the answer to that question is, how much price gain does it have for me if the market really sells off? And the answer is, unless the Fed's going to go to negative rates, which doesn't seem likely, not much. And how much in coupon am I going to get? Not much.
Right.
So the market, hypothetically, the market falls 30%. Unless you own some very long-term bonds, you may be down 28%, 29%.
Yeah. Well, no, and this is an important point. I mean, there was we've written about this before and talking about, investors over the last 20 years have not been paid to own the S&P 500. And, because if you own 100% of the index, you take on all the risk, right? So over the last 20 years, you went through the dot-com bubble, you went through the you went through the financial crisis and had a lot of volatility. Most people didn't survive those downturns because of the losses. But a 60-40 and even a 40-60 portfolio, 40% equity, 60% bonds, only slightly underperformed all the entire equity index of the S&P 500. The 60-40 actually gave you a better rate of return. But now going forward, the problem is that's going to become much more challenging. Equity volatility is going to be heightened, but also even the 60-40 portfolio, which will likely still perform, somewhat to a degree close to what you would expect out of the S&P over time, is going to be a lot more volatile in the future. And that's going to make it more difficult for investors to manage. So in your opinion, though, what's going to, and this is the thing that we're working with right now with our portfolios, is how do we hedge in the future? That's going to be the real question.
Right. And we've talked about it, and we have plenty of ideas, but they're not conventional, right? They're things we wouldn't have talked about years ago. They're things that, some of these ideas are things that most investors haven't spent more than 5 seconds on thinking about, haven't even realized that they're basically driving a car without insurance, right? They're so used to having the insurance that they don't even think about it, and they're driving like normal. Yeah, I may get a flat tire, may get an accident, but it's fine, I got insurance. Right. They don't have insurance right now. Most people do not have the insurance they think they have. And I'm not just talking again about retail. This is institutional. This is broad based. There's a whole field of investing called risk parity, which is basically a levered balanced portfolio, which heavily relies on those bonds to offset leverage in equities. And there, I think in March we saw some of it where some of these investors have to sell equities because they're just not getting a protection from the bonds.
Well, there's another side of this too with low yields and bonds. One of the biggest problems is, of course, the pension funds, which need to create a required rate of return every year. But because of those low interest rates on bonds, they're now having to push more and more of their pension funds into equity risk or other alternative risk. Right. As we saw with Dallas made some bad investments. But they're required to take on more and more risk because they can't lower their rate of return requirement, because for every percentage decline they lower their rate of return, pensionees have to contribute more to the plan. They can't afford it because their wages haven't been going up and their cost of living has increased. So the pensions really face a real problem here, and that's going to potentially, and that's not a small thing. That's like a $7 trillion issue that ultimately, the government's already talking about having to bail out, Illinois and other kind of municipalities because of the COVID issue and drop in revenues. But one of the big things on the horizon is a pension fund collapse, which is going to require a massive bailout by the government. That's going to be probably an issue that will resonate through the entire economy.
Right. And let's look at what some of them, not all of them, but what some of them have been doing to combat. So they, on average, they want to earn about a 7% return, and that keeps them up with the payments they have to make in the future. Right. 7% return is nearly impossible in bonds. It's, in the long run, that's the stock market average, but you're buying stocks at valuation highs. So your long-term expected returns are much lower than 7%. Mm-hmm. So what are they doing? They're borrowing money. In other words, leveraging up their equity portfolio. They're going heavily into private equity. They're basically taking on a lot more risk onto their books to try to get that return. And that, as we know, usually ends very poorly, Lance.
Yeah, usually does. And again, one of the big risks here, and then, if you take a look at the unemployment, right? So you take a look at the unemployment claims, and of course, we're clicking off, 1.5 million a week now in unemployment claims, and that's starting to stabilize at that level. We've got a lot more white-collar jobs potentially at risk of termination over the next couple of months. And if you take a look at the dispersion of those that have lost their jobs, it's primarily the bulk of the jobs are between 16 and 25 years of age and over the age of 65. So, all of a sudden, the people that are losing their jobs are the pensionees that were still working going, hey, I'm 66, I'm going to work till I'm 70, I'm going to work till I'm 72, I'm in good health, right. Everything's great, I like the income, I'm going to keep contributing to my pension. All of a sudden, they're being terminated, which means there's going to be a theoretical run on pensions where they have to automatically start paying out more than they were expecting sooner, which makes this problem even worse.
Right. All the pensioners are going to start drawing down 3, 4, 5 years sooner than they thought they were. Mm-hmm. And that's going to force them force the pension funds into selling, but also force them to take on more risk.
Yep. All right, Michael Lebowitz, CFA. Get his latest article on our website talking about the passive fingerprints on the markets. It's a really good write-up. You'll like it. It's on the website now, realinvestmentadvice.com. While you're there, make sure you're registered for our Candid Coffee. That's our conversation about, exactly this, retirement planning, unemployment, what to do, how to handle it. That's coming up on the next Saturday after next. On our website. It'll be a webinar with Danny and Richard, so simply sign up for that now and get our latest newsletter, podcast, more, all at the website, realinvestmentadvice.com. And don't forget to check out our subscriber service, riapro.net. We've got some really cool stuff we're rolling out there as well for you to help you manage your money better. All right, that wraps up the show for today, but stick around because Chris Salcedo is coming right up. And of course, we'll see you on the next edition of the Real Investment Show right here, realinvestmentadvice.com.
If I had a little money, it's a rich man's world. It's a rich man's world.